Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Well, still holding in the range. We'll call it the old range, 280 to 290, extended to 280 to 3%, and we've failed to get to 3% again. It seems like we dare the market to get there, and we just barely get within hairs, and then we pull back, and nothing really seems to capture. No momentum upside. Yield-wise, we no longer see any real major sellers pushing the market around. Equities don't have an effect on it. FOMC expectations don't have an effect on it. What could possibly move the market around here as we near the top of the range? Certainly, we need to get outside the band. I think at that 275 to 310 band we've talked about. Those are your big picture. You get below 275 yield or above 310, things may really start to move. But until then, the market seems very complacent and very comfortable holding within this 280 to 3%. And if we look at market volatility, yes, we are seeing a modest bid to market volatility. Recall about a week and a half ago, we put the lows in near year-to-date lows, and we've just seen a slow and steady pace trade higher. Not anywhere near where I would call a panic or a fear-driven market, but off the lows nonetheless, and that should be considered as we near these bands of the trading ranges. So nearing 3%, we see volatility rises, obviously in anticipation that we could get through that and maybe get back to that 310 level. Lastly, let's look at possibly the biggest reason why we're seeing yields get to where they are. We have the Treasury refunding announcement coming out. It's expected to keep most of the changes still in the short end. Obviously, recall the Fed has beefed up their two-year, 3-year auctions, and possibly now will be looking to add to that by increasing their 5-year auctions, as borrowing needs are expected to be enormous, or at least where price were. So right now we're seeing the front end of the curve continue to see more supply coming our way, and that's going to help keep the yield curve flat and keep those steepeners away. Ultimately, the yield curve must steepen, I think, in order for the Fed to continue to do what they want to do, and that's raise rates slowly but surely, because you have a 10-year yield that's kind of holding steady to going lower and a 2-year that's going up very dramatically, not only based on Fed expectations, but off of now more supply. It's going to cause quite the chaos when you see that yield curve invert possibly, and that will be the signal, I think, that the market is looking for any kind of forward guidance, is what will that yield curve do. So right now, a much more expected supply at this week's Treasury refunding announcement. However, we are going to start to see it slide out the curve a little bit. Instead of just being in that short 2 to 3 year sector, it's going to move out to the 5-year sector, and likely over the coming months and quarters, you could see it actually go out to the 10 and 30 year. That would obviously help keep the yield curve from getting flatter as we speak. But right now, yields in the 10-year stuck in a range. We have FOMC this week. We've got Bank of England coming up, and we've got the jobs report, all things that could give us a push in one direction or the other. This is Todd Colvin coming to you from the floor of the CME Group.